Hey folks, Joe Bongiovanni here from the Kettle Pond Institute for Debt-Free Money, monetary reformer. This is going out to the monetary reformers Google group, which has this very lively anyway thread on. Started out with a discussion of Bill Still's candidacy, and I just want to take you through my involvement and how I'm getting here to make this video to post. It was about Bill Still's candidacy, and I think I had the first comment on. I'm not even sure, but uh, I said, I would, I, w- I was glad that Bill was out there. Eventually, the person who posted the question on Bill Still's candidacy asked me if I would vote for him, and I said, well, it might depend on what he said about the Kucinich Bill, and exactly, and uh, it was posted on there anyway that Bill has 10 pages in his book, which I have actually obtained at this point, purchased I should say, at this point. But I actually right now have not had a chance to read his criticism, whatever it is. Um, but somebody commented in there with regard to Bill's criticism that Ellen Brown, had a criticism of the Kucinich bill that was about a couple of things, this and that, and I was questioning what it was, and I asked if it would be nice if Ellen could come in here and explain what it was because I didn't understand what was being said. And eventually Ellen did join in on the discussion on the group, for which we're all thankful, Ellen. Um, but when Ellen got on, she referred very early to what she called her critique of the Kucinich bill, and she provided a link to what she had posted on Huffington Post a few weeks ago, maybe a little bit more, having to do with the Fed and Wall Street. Something about the Fed and Wall Street, and which I had read. In fact, I had left a comment on her thing about the Kucinich bill. But which I did not see as a critique of the Kucinich bill at all. I don't even remember that the Kucinich bill was mentioned in there. Maybe I got to go back and read it again. But so anyway, I did not see that as a critique of the Kucinich bill. And when she said that was her critique of the Kucinich bill, and then she explained, what was in there was about the fact that it was going to create double jeopardy, as she said. Now, she had provided a link in the article and from the website, two links, one which took you to this book that cost $150 at Amazon, and the other that went to Winterspeak's blog. And I have been on Winterspeak's blog, so I went there and I went through the blog link, and there was nothing in there about the Kucinich bill. Neither was there anything in there about the claim that Ellen was making with regard to why the Kucinich bill created double jeopardy for bankers. And I want to explain that, especially based on my understanding of it, because I kept saying to Ellen, why do you keep making this statement that the banks create money out of nothing? She says they create money out of nothing, but they also then need to go out and borrow the money so that they can have it, the banks, in order to pay when a check comes in. Okay? No, not true. When banks create money, they create money. They create they create an account with an account number. Okay, that's in the clearing system, the reporting and clearing system of the Federal Reserve. That entry creates the money. Now I can't be, I eventually replied to Ellen last evening after she was confusing my comments, because the thing that happens is the day they make the loan, okay, the banks the assets and liabilities in terms of the deposits and loans and the equity of the bank, the balance sheet of the bank increases by the amount of the loan. How does it do that? There's money there. See, there's money there. The money supply of the country increases by the amount of the loan. Why? It's deposited in an M1 bank account. So the money is created. It's all created. It's there. It's done. And the guy takes the checkbook home and he writes a check and it goes, to the grocery store. The grocery store deposits it, scans through the numbers, and the accounting transfers take place to the account of whoever the check was written to. And I want to say, decreasing the balance on both sides. No, no, no. That check does not decrease the balance on both sides. It's the payment of the loan that decreases the balance on both sides. That check just clears the bank. That check just clears the bank. There's no reason for that check to not clear the bank. There's another check, and that's the check that the guy writes when he makes the payment for the loan. That's a whole nother matter. What happens with that? But the money that's created when the bank creates the loan is there, and it's paid out and recorded back against the entire thing. So, excuse me. There's no need for the bank to borrow any money to do anything related to the loan that's made, the money that's created when the loan is made. There's nothing, no requirement for the bank. I don't care what it says in the book that she says there where they use that example. I don't care. That may be an investment banking thing, or it may be some other financial services type of an institution. Okay. And it really, the whole thing was about overnight lending, being able to have that money there overnight. The money might not be there the next day. Well, that's how this fractured fractional reserve banking system works now. Everything's short term. Everything is borrowing the short term and lending the long term. Trying to create a long term payment stream, coming back in and using the short term borrowing that's available to fund it. It's insane. It's part of the problem of failure to match maturities that needs to be corrected. So the problem now is that Ellen's wrong. Okay, whatever she wrote in that blog post is wrong. Whatever she wrote, whatever statements that she's made here on this monetary reform blog is wrong. Her impression is wrong. And Ellen claims that there's a book, and I say, let's bring the people who wrote the book in here, Ellen claims that she has a, excuse me, a friend. I shouldn't say claims, because Ellen's told us that she has a person who's in her monetary reformers group that works at the Fed in, I think it was Boston Fed, and that person seemed to have affirmed somehow by using the language of that the check has to clear, that it affirms that the bank had to go out and borrow the money. And all I can say is, the bank did not have to go out and borrow the money. My number's in the phone book, spelling of my name. I live in Harborton, Virginia. And, I hope they could give me a call so that we can discuss it. Now, it's only because Ellen has this newfound belief. This is not consistent with what's written in her Web of Debt book, at all. If you read either her chapter on the Wright-Patman hearings, Jerry Warhis hearings, or if you read through the publication that they made, it shows that banks create money out of nothing. They create money out of nothing. Well, the things that serve as money these days, which is bank credits, they serve as they're recognized as legal, as meeting the obligations of money, requiring some of the functions of money. One of the functions of money. So because Ellen has this wrong interpretation of what happens, Ellen uses that wrong interpretation of what happens as a criticism of the Kucinich Bill. And it's an invalid criticism. There's no double jeopardy created to the bank. The bank, when it made the loan, it created the money, didn't create any obligation upon itself. Quite frankly, did not create any obligation. Didn't even create a single jeopardy on itself. Okay. All it created was a bank account, which has by virtue of its charter has the authority to do. So so there's no double jeopardy created, certainly by virtue of a resort to uh, the transitional measure. It's only the transitional measure, by the way. People have to understand that to achieve the permanent money system that the Kucinich Bill achieves. You know, anybody who doesn't understand what I mean by the permanent money system should just Google up Robert Hempel's quote on money. Robert Hempel, the Atlanta Fed's credit manager, a long time ago, he was actually involved in bringing the Chicago Plan for Monetary Reform forward. He said, you know, we're without a permanent money system. We rely upon the banks to have money or not. Banks making loans to have money or not. If the banks make loans, we're prosperous. If they don't make loans, we're in jeopardy. We're in jeopardy. The economy is in jeopardy. And he says, you know, that's a travesty that needs to be fixed. And that's why we're monetary reformers, in case people don't know. Because he's right. You know, he was the Atlanta Fed credit manager. He saw how the system works. And he saw how the inability of having a national medium of exchange that functions for the national economy, which would do away with all of this, you know, hyper wealth creation to the people who issue the money, who create the money. You know, we correct all of that, and that's what's out there. So, but in the process of achieving that, the Kucinich Bill says, yeah, we are going to monetize that bank credit debt. Now, those are my words, monetize, okay? Because what they're going to do is, by virtue of the sovereign power to create money, they're going to create the money, and they're going to put it in the bank account and transform that bank credit debt into real money, into real United States money, okay? Now, in order to maintain a permanent money system, this is key to understanding what happens. In order to maintain the permanent money system, that money once created, we have a money supply, we just transform the money supply into real money. In order to maintain the permanent money system, we need to get the money back from the people that we just gave it to, okay? We gave it to them. So yeah, that payment has to come back to the Treasury. If it doesn't come back to the Treasury is not creating a permanent money supply. Now, Ellen says that in order to do that, it's going to create double jeopardy on the bank. Well, it's not. Okay, there was no jeopardy that was created on the bank in the first place, and that payment going back in return for the money that went in, there's no jeopardy to anybody, quite frankly. It doesn't create any jeopardy to anybody, and not double jeopardy. So, I'm sorry, you know, to Ellen, somebody who's I've admired for such a long time, you know, that we're into this disagreement. But as a monetary reformer who wants to see monetary reform go forward, I see it, you know, it's just a huge obstacle right now in the road. And the fact that it's a basis for a criticism of the Kucinich Bill, I guess that's what makes it unacceptable to me. You know, there could be plenty wrong with the Kucinich Bill. Nobody does anything perfect, you know. But we want to talk about what those are. But if we were going to be creating double jeopardy on the banking system, I think you may say that they're going to go broke. You know, if the banks are going to go broke, well, we can't do it. But if it doesn't do that, then we can do it. Ellen got into the thing last night with my comments back and forth, and the irony that I found out of reading my comments back and forth when I described first the fractional reserve banking system and how it creates money, and then, under the Kucinich Bill, how money would be created. The irony is this. Under the Kucinich Bill, in order to create money, in order to lend money, then you need to actually borrow money. You need to have money in order to lend it. Whoa, imagine that. You need to have money in order to lend it. So the irony is that what Ellen is claiming, you know, there in this transactional, you know, thing that goes on between the bank and the borrower, is actually what happens under the Kucinich Bill. It's why we need full reserve banking. This is most respectfully submitted to the Google Group, Monetary Reformers Google Group. Thank you.